All right, welcome to this episode of Market Shares. I am back with my good friend Anton Stetner. I think we're going to do a little series of videos with Anton because there's so much to talk about. But I want to bring Anton in first because we're going to talk about what's going on with interest rates, what's going on with the market, with inflation, and all that fun stuff. So this is going to be a great conversation. Anton, welcome to the show.
Thank you, sir. Thank you for having me back, and look forward to talking.
Yeah, I think there's lots of confusion out there. We've definitely saw some good news last week for the first time on inflation. I think for those of us that watch the market very closely, if you're in mortgage and real estate, maybe you knew that it was anticipated that the year-over-year inflation number would drop when CPI came out last week. It came out at 0.4. It was replacing the number from a year ago, which was at 0.6, and so the year-over-year number came down. And it's kind of expected that that is the beginning of a trend, maybe with inflation coming down.
Fingers crossed.
Fingers crossed. I think the question is how much does it come down? How quickly does it come down?
Yeah.
And how is that really going to translate back into lower interest rates, or is it?
Yeah.
You know?
And, we were kind of talking about this right before. I think inflation is going to pop apart in chunks. So like that first chunk is the first 2% for conversation. That's easy, okay? The second 2%, that's going to be a little bit stickier. It's going to be harder to get to. And that last 2%, that's going to be the rock hard, how do I get it to move inflation? So I think the stock market overly responded to what happened. I mean, you just saw it go on a tear, right? Yeah. But I think it's going to take longer than the American public wants it to. But the first part of it's going to happen quickly. What are your thoughts?
Yeah, well, no, I think it will happen quickly because it ramped up so quickly. I think we'll see it come down quickly. But yeah, I think it is going to be stubborn. One thing that's very interesting about what happened when CPI came out, I mean, I kind of expected it to be a lower read, and I expected to see about a 200 basis point rally in mortgage-backed security prices. And turns out that's exactly what we saw. Like MBS rallied by 200 basis points in one day. But here's what's interesting. So if you're in the mortgage business and you're watching your interest rates, we didn't see rates get better by a full 2 points.
No, not even close.
Not even close. And there's a couple reasons for that. One is that, well, it happened right before a 3-day weekend. And so your capital markets team is not going to push through all of this, benefit because there's a lot of locking happening over the weekend. We don't know how the market's going to open on Monday. So that was part of it. But here's the other interesting thing that people don't realize is that when interest rates are up in the 7% range, and all of a sudden we have a 200 basis point drop, all of a sudden those interest rates in that 7 area, high 6s, low 7s, all of a sudden the servicing value of those loans gets eroded really quick.
Oh, interesting, yeah.
Yeah, and so the market realizes that, oh boy, these higher rates aren't going to last very long. They're probably going to get refinanced because rates are coming down. So we have two things happening kind of inversely. We have the actual underlying MBS price improving, but the servicing value of those higher coupons is eroding at the same time. And so that ate into it. So I had a lot of people go, gosh, how come my interest rates didn't improve as much as I expected? And it's because on these higher coupons, servicing dropped at the exact same time that the MBS price got better. So because of those couple factors, we didn't see as much. But the good news was then this week, we followed with the producer price index. That came in a little bit lighter as well, which is wholesale inflation. So everything's kind of pointing towards lower inflation. And I think you will see these interest rates ease themselves back down. Maybe just, it's always, it's like a feather, right? It's like they shoot up like a rocket, rates do, and they fall like a feather. Yeah. So everyone's a little bit slow to release all the benefit. But as long as we continue to see confirmation of what we saw last week with CPI, I think you're going to see rates steadily improve as we move towards the end of the year.
And, one thing that also may be happening directly to the consumer right there is that may have been peak fear. So, we don't have a way to measure this, but if inflation is just going up, and it's hurting their pocketbook, and then we get some good news, and multiple sets of good news in a row, that starts to help that consumer build in that confidence. And as the market, basically that fear starts to pull out of it, that's what helps to establish, a really solid foundation for, real estate to go up, and then also lots of transaction volume, which forces banks to become competitive on those rates too.
Yeah, 100%. So let's talk a little bit about what consumers don't understand about interest rates. I know we've talked about this, but what are some things that you hear where there's confusion, where maybe we could clear up some confusion?
I think real simply, it's how do long-term rates affect short-term rates, or how does the Fed, when they change, what does it mean to me, the consumer, in a 30-year fixed mortgage?
Right. Nothing. Right. So,
well, and the media doesn't portray that to me. So tell me more about nothing.
Yeah. So here's what happens. So the Federal Reserve really only controls the overnight cost of funds. And this is really money that banks charge each other to borrow funds overnight. So if you think about, a graph, and on one end you have 0, on the other end you have 30 years.
Yep.
The overnight is literally the shortest amount of time that you could borrow money.
It's right there at the
literally
front.
Overnight, right? And then you have 30-year debt all the way at the other end of the spectrum, the yield curve, if you will. And so the Feds, by moving short-term rates, they really don't have any direct impact on 30-year fixed-rate mortgages. However, what does impact 30-year rates is inflation. And the reason for this is because if you invest in a 30-year mortgage as an investor, buying that security, you have a fixed amount of income coming in from that loan. So if the interest rate to the client's 7%, maybe the coupon on that is a 6% coupon after fees. Let's say you're earning just 5% for an easy round number. It's probably a little more than that, but let's just say it's 5%. So if you're earning 5% on $100,000, you're receiving that same amount of money every year for 30 years. So if inflation is going up, then what I can purchase for that 5% of that 100,000, because that stays static, it starts eroding over time. That's right. And so inflation, the great analogy that I've always heard is inflation is like a fire. It's like an inferno, and your mortgage is like, if you're the investor, it's like holding an ice cube. And as inflation goes up, it starts melting my ice cube. It's worth less. So what the Fed is doing is they're raising the overnight cost of funds with the goal of bringing inflation down. And so what happens a lot of time, and this is where the media gets it wrong every time, is that if you're a bond investor and you go, okay, the Fed is the firefighter in this example. So the Fed is over there raising rates to put out the fire. They're trying to lower inflation, and mortgage rates will actually get better in many cases because they go, oh, thank God, they're fighting the fire. I can now continue to invest in longer term maturities and not have the same fear that it's going to erode its value over time. And so that's why you almost see an inverse reaction between the Fed, the actions the Fed takes, and what mortgage rates do on especially those days when those announcements come out. Now, if the Fed doesn't do it right, though, like many times, like this is a perfect example coming up here in December. So a lot of people are thinking the Fed was going to do another 75 basis point hike. Okay, they might. But maybe they only go 50. So what will happen is if the market
my bet is they go 50.
I think they're going to go 52.
I think we need the hope. We need it's going to be okay.
Right, but if I'm a bond investor, are they going to my concern is, are they going to let up a little bit too early, and inflation is just starting to get better, and the fire flames back up. And so it really depends on what the market is expecting them to do and then how they react. And this is where it's very confusing for people too, because we can often see where the Fed makes a move and we go, gosh, okay, so the Fed raised rates. But if they don't do what's expected of them to do, then the market can have a negative reaction. And so there's nothing simple about predicting A, what the moves are going to be, and then B, how they're actually going to impact mortgage interest rates.
So if we've got short-term rates are right here and our long-term rates are out here, and we know that the consumer's interest rate went up. What factor plays into that consumer interest rate? What year bond, or where is that in that curve that caused us to move from low threes up into the sevens, now back into what are we, upper sixes today?
Right. So again, it's just the bond market's demand for those mortgage-backed securities. So they're it's kind of like a stock.
Yep.
In that as more people want to buy a stock, the price goes up, right?
Yep.
So when there's not enough demand, and keep in mind, with mortgage rates in particular, the Fed is not only controlling monetary policy, they were also doing quantitative easing.
Yes.
Right? So they were purchasing mortgage-backed securities, a lot of mortgage-backed securities, and U.S. Treasuries. And so they were creating that demand. It would be like Amazon buying their own stock so much that it drove up the value, right?
Yep.
That might not be a great example, but you get the point. It's like there's this false sense of demand for these mortgage bonds and treasuries, and they did that intentionally to keep rates low during COVID, okay? So what happened is it had very little to do with the moves that the Fed started making to raise interest rates, but what happened was inflation started going up, which erodes demand, especially when the coupons are so low.
Yep.
It's like if inflation's at 5 and my coupon's at 3, literally this will be worth nothing if inflation stays up here, right?
Yes.
So I need my yield to be higher than inflation, and so that's why it had to come up.
The only way they can do that is by discounting that bond.
That's right. And so, well, it happens naturally because there's less. So the Fed stopped buying.
Yep.
Okay. They started tapering their purchases, still reinvesting the loans that were running off. Right. So they were still doing that. But so there was this false sense of demand. And as that started pulling back, like anything, there's less people buying them. Then the price starts going. Excuse me. The yield starts. The price starts coming down.
Yep.
Let me get this right. The price starts coming down because less people want to buy it, right?
Yep.
Like anything. So less people are buying, price comes down. As the price comes down, the yield goes up.
Yep.
Now, at some point, I talked about this on the podcast, is that at some point you start getting these yields so high, you start going, well, so I can get 5.5% on my money with zero risk.
Yes.
All of a sudden, that looks better than the stock market,
on the
right?
safest investment in the world.
That's right. Backed by the federal government, right? And so secured by real estate.
Yes.
So that has already started to happen, and you're starting to see more and more people save their money. So what the Fed's trying to do is bring down inflation. That's too many dollars chasing, too few goods, which was created by a multitude of things. We had all of the PPE, we had all the stimulus, we had all the supply chain issues bringing down that. So this is like a perfect storm. So the Fed wants to slow things down, and by yields going up, part of what that does is it makes people who actually have money, instead of maybe spending it, because they were forcing people to not save money by paying them 0% yield on your savings.
Bingo. It keeps the money moving around.
Keeps the money moving. Well,
Yep.
now all of a sudden, if I got some money, I'm like, hey,
Yeah.
I can actually make a decent return on this. Maybe I want to start shoveling some money away, but that pulls money out of the economy, right? And so the quantitative easing slows down, the amount of savings goes up. All of these things working together are what is going to bring down inflation. And when inflation comes down, so too will the long-term bonds. It really is not directly tied to the Fed funds rate, and that's where the confusion comes in. But they all work together. It's all part of a system. And so, yeah, there is a correlation between what the Fed's doing and long-term rates, but not a direct correlation.
Yeah.
They're trying to push over here to move things over here, if that makes sense.
It's like boats in a harbor. The wave comes by and it kind of moves all the boats, but the boats are not directly connected.
Exactly. Yep.
So what if I'm looking at, because we kind of talked about this before, 5-year or 10-year treasuries, how does that relate to 30-year fixed debt that, our consumers generally see?
Yeah, well, what's actually interesting, so you typically see a spread between the 10-year and the 30-year. A lot of people track the 10-year because it's just easy to find. You can just go on Bloomberg and see what. Yeah. So it's really easy to find, and historically speaking, 30-year mortgage rates and, MBS prices and the 10-year, they tend to trend pretty darn closely. You're actually better off looking, though, at the 5-year.
Okay.
And the reason for that is because even though it's a 30-year fixed rate mortgage, no one keeps their mortgage for 30 years.
Yeah, exactly.
Okay? So if I'm a servicer of a 30-year mortgage, it's really more like a 5-year note because on average, that loan's only going to be in my servicing portfolio for 5 years.
Got it. And then they refinance,
sell their home,
whatever
do something different, right? And so they tend to trend close to that. But bottom line is this, is that the typical spread between the 10-year and the 30-year is about 200 basis points. So about 2 points different between, if the 10-year's at 4, you'd expect mortgage rates to be at 6.
Yep.
Well, where are mortgage rates right now?
6.75?
They're almost at 7.
Yeah.
Where's the 10-year? It just dipped under 4.
Yep.
We're at like 300 basis points spread right now. So
So what's causing that bigger gap?
Well, it's a lot of things. It's complicated, but it really comes down, honestly, to the servicing value of those higher note rates. So think about this for a second. If I just said the average life of a 30-year mortgage is 5 years.
Yep.
Well, if rates right now are at 7, inflation's already coming down, and we think rates might be at 5.5 by the middle of next year.
Yep.
Now, how long do you think that 30-year mortgage is going to be on my books for?
12 months, 9 months.
12, 18 months maybe, right?
Exactly.
So it's not going to be there for 5 years. And so as a result, I need more premium today in order to give you that note rate. So that's why you see a lot of loans where you got to pay points to get them, because there is no premium price. I can't just raise the rate and assume that I'm going to collect on that for a longer period of time. So that's causing that divergence.
Yes.
And just that 100 basis points alone, as that kind of comes back down, as we get interest rates into a range where refinancing them isn't a for sure thing, and we think that the life cycle of that loan might be closer to 5 years or 4 years, you will see that 100 basis point spread erode. And then that, in addition to inflation coming down and more investors into mortgage-backed securities, the combination of those things are why it's projected that mortgage rates are going to be in the mid-5s by next year.
So basically, as inflation starts peaking, which we believe we're probably peaking right now, hopefully it doesn't bounce back up. But as inflation peaks and as more people purchase mortgage-backed securities, more liquidity comes into that market, what we can expect is long-term interest rates to float down.
That's right. And I don't think it's going to happen super quick. I think kind of like the analogy you gave with inflation, where the first 2 is going to happen quick and then it's going to be more stubborn. That's what I expect to see with mortgage rates this time. You're going to see a quick drop, which we kind of saw last week when CPI, 200 basis point move is huge.
Huge.
So I think they continue to go down. And one of the analogies Barry Habib uses all the time, which is an economist, if you're in the mortgage business, you know who he is. But and I love this analogy. It's like a kid that's playing with a yo-yo going down an escalator. So the market's the yo-yo. So it's going down, but it's gonna do this on its way down. So and I don't think it's gonna be super steep. The last time we saw rates drop was in March of 2020 when COVID hit. And it, just like the stock market, fell, mortgage rates fell,
just
the
plummet.
Fed, everyone threw everything at it to get rates down. That's not the way it's going to work this time. And so it's going to be important that you work.
Because they're worried about those crazy inflation fires coming back up. So when inflation peaks and the Fed stops raising its Fed's fund rate, it's going to most likely just let it sit there and plateau for a few months to make sure that fire's stamped out.
That's right. Yeah. Well, and I think other things are going to start to happen, right? I think it'll be interesting to watch employment numbers.
Yep.
Employment, one of the things that's unique about this market is that we have inflation really high. The Feds are trying to slow things down, but employment's been so strong.
It's so low.
Right. Unemployment's so low. But
everyone who wants a job can have a job, and there's other jobs available. And so one of the other reports that they were looking at was quits.
Yeah.
quits is a really unique measurement. That's the measurement of I'm quitting working for company A to move over to company B for generally a raise. They want to see that transition stop because that's one of the things they get afraid that wage price spiral is going to happen because I quit A to go to B for higher pay. They're trying to slow down the quits and then also bring up the unemployment all at the same time. But that's been surprisingly stubborn.
Well, until now, I think it's going to be interesting because if you see there's a lot of tech companies over the last just week
here
that
in
have
our
announced
area,
layoffs.
I mean, in the Seattle metro as a whole, we've seen the tech layoffs start. So we're probably the beginning of that, and then the rest of the country will fill it. But we just happen to be one of those tech meccas.
Right.
And they've laid off, each one, Meta laid off, Microsoft, Amazon.
Well, and Google, they didn't lay off, but they have a hiring freeze, right?
Yep.
So some of the big companies have put a freeze in place, or they've lowered their projections on how much growth they're going to see. And then, like I said, many have announced 10 to 15% layoffs, like Meta and whatnot. So it's, that we haven't seen the numbers yet. So when we start seeing those numbers, that's going to be further. It's going to be further proof, if you will, further confirmation that the economy's slowing, inflation should come down, all of those things.
Well, one of the things that we're totally looking at here is the Federal Reserve is looking in the rearview mirror at all of these statistics.
Right.
So when they're making an adjustment, that is from a lagging number that's now showing up. And so that's one of the reasons everyone says, well, the Fed always overcorrects. They overdo it. And they kind of do it that way on purpose because they have to stomp out the fire. But they don't want to have these giant moves. They want to just move really slow, very predictable for the market.
Yeah, well, I don't think the Fed originally thought they would have to go this aggressive
No, they
against
did
inflation,
not.
right? And they thought it was transitory. Like it's
it was transitory.
It's kind of a joke at this point.
This is fake inflation.
That's
it's not real.
That's right. Well, and so they've had to get really, really aggressive. And you know what? I think they're totally fine overdoing it.
Yes.
Because as long as, like you said, it's like you can't be too careful putting out a fire, right? Especially like if you're out camping, a little extra stamping it out, a little extra water. Like let's just make sure we're not gonna, let this thing flare back up. And they're gonna do that, and that's normal behavior for them. But it also does. Here's another thing that an analogy I love, and I don't always use gun analogies, but this is an optimum place. The Fed only has so many bullets in their gun.
Yep.
And when the economy slows down, they start shooting those bullets at it, right? And that's what we saw with COVID. They didn't have a lot of room because they had raised rates a little bit. And so they had a little bit that they could lower it, right? From like 1, 2 down to 0 or whatever, right? They didn't have a lot to work with.
Yeah.
So now the Fed's completely reloaded. They have all sorts of ammo stored up. So if we do see the economy start to slow, now they have things they can throw at it to fix it, stimulate it, lower rates, etc. So they're in a much better position to overcorrect this one and then say, but we'll just stimulate it back up if we need to.
Well, and that's what Jerome Powell said at the press conference following the last meeting. Was he said, we are going to push hard. We're going to overcorrect if necessary. He said, and we can turn fast to stimulate the economy. We've proven we can do that. So they know that if things get too bad, they'll just turn it around.
Yeah. Well, what they've never had to do in recent history is fight inflation like they're doing right now. So this is kind of unprecedented for them. And they know how to stimulate the economy. We've seen that,
Yeah. Turn on the money printers.
Exactly. What else? Anything else before we wrap up this segment talking about the market, about interest rates?
I think specifically for buyers, right? And as a buyer is looking at a property, this is just something somebody said. They said, well, interest rates are going to be 7 forever.
Right.
And how do we help buyers with that? That's number one. But number two also would be there's no way I can qualify today. So I think those are the two questions we should just talk about. And we've kind of already alluded to it, that interest rates are going to change, but what causes interest rates to change? Because I think buyers are just genuinely concerned that they'll be stuck in a 7% rate for the next 10 years.
Right.
And that they won't be able to get away from that higher payment.
So I think that there's never been a better time in the last year to have this conversation with a client, because now we have the evidence of inflation coming down for the first time in over a year. And so that actually should help a lot, because like I said, the Fed funds rate has little to do with mortgage rates. They're driven by inflation. And so you can sit with your client and you can explain to them, look, we've had inflation going up. It's been, much more stubborn than we thought. And now, as expected, October CPI showed us that it's peaked and it started to come down. And you can give them a level. It beat
So it beat expectations, which caused interest rates to then drift down, not the full amount, because, they had to keep some on the table.
Right.
But then interest rates came down because of that.
That's right. Yeah. So I think we have evidence now that we've turned the corner. That was, again, confirmed by the producer price index again. And if you look at one thing that we see a lot in the mortgage business, because we understand the charts and how this works.
Yep.
But the reason why we were pretty sure that inflation would come down, that CPI would come down, is because we could see the number October of 2021 that was being removed and being replaced by the new number. So and those numbers even go higher.
So there was a big number in last October.
That's right, 0.6.
Okay, and then it was being replaced by
0.4.
And then, so inflation, one of the things, everyone listening to this to keep in mind, it's a year-long aggregate of all that added up.
Right. It's a rolling 12 months of a monthly CPI number. This month's number was 0.4. The one that dropped off was 0.6. And so as you roll forward, a new 12 months.
Yes.
Okay. So the one that's going to be dropping off for November, I think, is 0.6 or 0.7 as well. So as long as we get a read that's under that for November's CPI, we'll continue to see that improve. And we're going through a few months of where we saw the highest inflation towards the end of 2021. No surprise, by the way, that even though we weren't seeing really high numbers through the summer, it was replacing numbers at like 0.2, 0.3, right? So they were very low in July, August, September.
Yes.
October was the first high month at 0.6. So we could kind of predict that this was going to happen. And it does, we would have to see a really high read on inflation for this kind of trend to stumble. And it's just unlikely that that's going to happen.
I love it. So inflation's trending down. We've got a great month-over-month number. So long-term, we know that's going to move into rates. Let's go to the second part of that question. And the second part of that question is, how do I qualify today? What do I need to do? Because once again, I think the consumer's looking at it in just this granular rate is X, price is this, so prices, we're seeing compression, right?
Yep.
But there's still a delta between what they were paying before and the number today. And to be honest, everyone, that delta is your massive opportunity. And as it gets closer, your opportunity is going away. But for the consumer, how do we help them bridge that gap?
Yeah.
What can we do?
Well, I want to unpack this a little bit more in our next episode.
Okay, perfect.
Because we're going to talk about real estate.
Yes.
Is it still the right time to buy? What's going to happen with real estate values? We've talked about rates. But I will just give a little teaser here. There are some things that we can do to help our consumer today bridge that gap.
Okay.
Obviously, as you mentioned, sellers are much more willing to negotiate and help contribute towards the purchase of your home.
Massively.
You can use those funds to do a number of things between, 3-2-1, 2-1, like temporary buy down solutions. You can do permanent buy down solutions. Yep. Obviously, you can take price reductions. Doesn't have as big an impact on the monthly payment, but depending on how long you're going to be in the home, that may or may not be the right way to go. So one of the big things is leveraging the seller's money. I think one of the other things too, that it may not feel this way if you're the actual consumer, but if you look at the numbers, you spoke briefly, mentioned, wage inflation.
Yep.
Keep in mind, wages are up as well over the last 2
Yes,
years.
sir.
And so on average, even though rates are higher and we personally don't like it, most of us have also seen an increase in our pay, and they can actually afford more today than they could have as well. So that's another fact that we can't just ignore. And again, as the person taking the interest rate, you just want the lowest rate possible.
Always.
But as an industry, we do need to look at the fact that rates are up, affordability has gotten worse, but wages are up as well, and that helps to keep us pretty close to the same affordability levels that we were at even with lower interest rates, if that makes sense.
Love it.
So we're going to talk about more strategies, but let's wrap up this episode on update on the interest rates, the market, and we got a lot more to talk about. So check out future episodes where me and Anton are going to continue our conversation. But until then, you guys, thank you for your time and attention. If you haven't already subscribed to Market Shares, please do so. We try to bring, industry updates, things that will help you with your business, but also timely updates on what's actually going on in the market today. And so, Anton, thanks for sitting in on this episode, and we'll see you guys on the next one.
Perfect.